Hello. In this video, I'm going to talk to you about margins, markups, provision for unrealized profit. The first part of the video is going to be useful to those that are taking PM, Performance Management exam. And the whole video is going to be essential for those that take Strategic Business Reporting, Financial Reporting, and Diploma in FRS exam. My name is Liliya Kirylenka. I'm an ACCA member. I took and passed ACCA on the first try ages ago, and I teach adults how to do that, how to pass with minimal effort, with minimum time requirement, because you're an adult, you have responsibilities, and I value that. Now, first we are going to talk about markup and margin. What is the difference? Markup is going to be given on cost. So if, let's say, you have cost of $100, you have markup of, let's say, 25%, then this means that the revenue that you are going to get, or the price that you are going to charge, is going to be 100 multiplied by 1 plus 25%. Meaning that revenue that is going to be earned is going to be $125. And your P&L is going to look like revenue 125, cost 100, and your profit margin, your gross profit is going to be 25. So if you are given markup of 25%, then this means that your profit is cost multiplied by markup. So your profit is 100 multiplied by 25% equals 25. Your revenue is cost multiplied by 1 plus markup. So this means you are going to take 100 multiplied by 1 plus 25, and that is going to give you $125. If, on the other hand, you are given revenue, so if you were told the transaction was at $125, then your profit is going to be revenue or price multiplied by markup divided by 1 plus markup. So meaning that your profit is going to be $125 multiplied by 25% divided by 1 plus 25%. And also it means that your cost is going to be revenue divided by 1 plus markup. And this means that it will be 125 divided by 1 plus 25%. This may sound overwhelming, so what I suggest people do is put X's. So your cost is going to be your X. Your profit is going to be your 0.25x or whatever the markup is given to you. And your revenue is going to be as such 125x. And in this case, when you write it like that, when you visualize, it will be easier for you to find the x based on whatever is given to you. So that was markup. What would be different if we had not markup, but rather profit? So gross profit margin, something like that. In this case, we would have the following difference. Margin is given on revenue, on price. So imagine that you have revenue of 125. Imagine that you are given a profit margin, and let us think about what the profit margin is going to be. So imagine that you are given a profit margin of 20%. So if your profit margin is given to you as 20%, then your profit is going to be 20% multiplied by 125 equals $25. And your cost is going to be the difference between the revenue and the profit that you are going to earn. So your cost is going to be 100. And let's have a look at whatever can be given to us and what do we do with that. So if you need to calculate profit and imagine that you are given a cost of 100 and you are given a margin, not markup, then instead of multiplying cost by markup, you are going to take the cost, you are going to divide it by 1 minus margin and multiply it by margin. Let's have a look. You take 100, you divide it by 1 minus 20%, and you multiply it by 20%, and you will not believe me, you will get $25. Revenue is going to be found as cost divided by 1 minus margin. So it will be 100 divided by 1 minus 20%, so 100 divided by 8%, and this will be 125. If you are given revenue and not cost, so this means that you may be required to find profit, and profit is going to be revenue just multiplied by margin. So this will be 125 multiplied by 20%. So this means 25. And cost is going to be found from revenue as revenue multiplied by 1 minus margin. And this will be 125 multiplied by 1 minus 20%, so by 80%, which is 100. So everything is kind of the opposite. And again, try to put axes. So if I put X to revenue in here, I will say that my profit is, let's say, how much is that? 0.2x, right? Because my margin was 20%. And this means that my cost is going to be 0.8x. So if I am given cost, if I'm given the value of this 0.8x, I can find x dividing the cost value that is given to me. I will find x by taking the cost that is given to me and multiplying it by 1 minus margin by 0.8. So the same idea that we had in here. That is how we find that. Now, let's have a look at how it works when we have provision for unrealized profit, how it works in SBR, in financial reporting, and diploma in FRS. So when we have two companies that are trading and they are related, we will need to make an adjustment. And basically, the situations that we can have is parent sells to subsidiary, subsidiary sells to parent. And different situation will be when there is an associate that trades with parent or subsidiary. We are going to talk about consolidation first. Now, if parent sells to subsidiary, you need to think about what to exclude. So first of all, what is that you do? You need to eliminate revenue in full. So eliminate revenue in full. And the revenue that is going to be eliminated is going to be eliminated as debit revenue, credit cost of sales. So we are going to take that inflation because when we sell left pocket to right pocket situation, we do not want to overstate the P&L. We do not want to show our company bigger than it actually is. And this will be for the full revenue. So we are going to take the full sales regardless of how much is left. Then we are going to look at the profit. We are going to look at the percentage of materials or whatever that is left in the books. And what will be the adjustment? The golden rule is that you are just statement of financial position of one company, and you adjust P&L of the other company. So let me give you a numerical example. Imagine that we have revenue of 1,000. Imagine that we have, let's say, margin of 20%. Imagine that, let's say, 30% of the goods were not sold. So what are we going to do in this situation? In this situation, we are going to take away the full value of revenue and cost of sales, so this 1,000. Then we're going to work on provision for unrealized profit. So for the provision for unrealized profit, if it is parent that sold to subsidiary, then this means that parent recorded income, P&L, and subsidiary included inventory. So the adjustment that we are going to make is we are going to adjust inventory because inventory is overstated now, so we need to credit inventory. And we also need to debit P&L, debit cost of sales. And as we debit cost of sales of the parent, we don't share with NCI because it is parent's profit, not subsidiaries. Now, what will be the numbers? Well, as for the numbers, we do not care how much subsidiary is owned by the parent. So if, let's say, parent owns 60% of the subsidiary, we do not care about that because we control inventory in full. And as such, we need to make this full adjustment to inventory. So we are going to look at the profit that was earned, which is 1,000 multiplied by profit margin of 20%. And we also look at how much of the goods is going to be unsold. So $200 is going to be multiplied by 30%, so it's going to be 60. And that is our entry. Now, what will be different if the situation is the opposite? If it is a subsidiary that sells to the parent. So if subsidiary sells to the parent, well, we still are going to eliminate revenue and cost of sales in full. But in this very situation, when we are going to credit inventory, it's going to be inventory of parent. The adjustment is going to be made in the same amount. But when we are going to adjust cost of sales, it will be cost of sales of subsidiary. And cost of sales of subsidiary means that it's going to be shared with NCI. And this $60 as such is going to be split. So you are going to record to NCI as reduction this 60 multiplied by 40% of whatever the NCI holds. So it is 24. And retained earnings in statement of financial position, they are going to be reduced by the remaining. So 60 multiplied by 60% of parents' holding. So this is 36. This is whatever happens in statement of financial position. In P&L, we are going to put the whole value of 60 with a minus sign in subsidiaries column. So this means that our NCI will get the profit reduced by a share, by their own share. And that is what we do when we have group accounting, when we have parent and subsidiary. So once again, revenue and cost of sales is eliminated in full. Parent to subsidiary and subsidiary to parent share is eliminated like that. There is going to be one short nuance that I'm going to talk about in the very end of the video. So it's something that is tested not super often, but you need to be aware of. And in the meantime, let's talk about what is going to happen if there is a trade with an associate. So if parent trades with associate, so what does it mean? It means that associate is not consolidated. So we do not have revenue and cost of sales of associates. So revenue and cost of sales is not adjusted. Instead, we just are going to make this provision for unrealized profit. And look how interesting it is going to be. When we are going to have this provision for unrealized profit, we are going to pay attention to the direction even more than we do for subsidiary. Because if you are going to have sale from parent to associate, then what happens? Parent is going to record P&L, but an associate is going to have inventory. But for an associate, we do not have inventory because we do not consolidate it. So the only line that we have in respect of associates in our statement of financial position is investment in associate. So the entry that we are going to have is debit cost of sales of the parent and credit investment in associate. So that is one difference. So there will be no inventory but investment in associate. Another very important difference would be that in this case, we are going to include just our share. Because in this case, there is no control. In previous scenario, we could have controlled the full value of inventory. So this means that we did not need to account for our share. In here, we do. So imagine that the sale was for the same revenue, for the same margin, and the same goods were not sold, but also parent has 40% of the associate. So in this case, when we are going to make the calculation, we are going to take 1,000 multiplied by 20%, multiplied by 30% to account for whatever was not sold, and then multiplied by the share. So the adjustment will be made just for $24. And the same idea for credit, obviously. So see, the same as was adjusted for NCI in this case. Okay, so this is when the direction is from parent to associate. But what would be if the direction is the opposite? What if it is an associate that sells to a parent? Oh, not that hard at all. So if an associate sells to parent, then, well, parent is going to record inventory. So they are going to adjust statement of financial position, so credit inventory. But associate is going to record P&L, but we do not consolidate revenue and cost of sales and the rest for the associate. Instead, we have just one line, which is profit from an associate. So instead, debit is going to have profit from associate. And the calculation is going to be absolutely the same. So the number is going to be the same. The difference lies only with where to account for it. And that is the idea that you need to get. And the idea is whether you do control or you do not control. If you do not control, you just take your own share. If you do control, you make the full adjustment for the full provision for unrealized profit. And the difference between associate and subsidiary would be in this 40% that is multiplied in here. And also you can have different situations where you have not margin, but rather markup. That would be different as well. Now, one tiny exception that can be, which is not tested super often, but so that you are aware of. When you make an entry, well, actually, you need to make an entry for the difference. So let's say if on the start of the year, you had PURP of, let's say, $10. So if in previous year there was intergroup sale and there was some goods that were unsold, then this year, the adjustment to P&L is going to be made just for the difference. So yes, the closing balance of inventory is going to be adjusted for 60, but the P&L itself, the entry that is made, is going to be made just for the 50, 60 minus 10, because the adjustment of 10 is already in our account, so we need to just charge extra. Now that is how it works. That is what usually helps my student to have their head around it, because unfortunately we have all of that split between different chapters, so it is great to have this helicopter view. I hope that it was helpful to you, and good luck with your preparation, and see you next. Bye.